Yeah, so while everyone's logging on, I'll tell you my recent home shopping story. You'll get a good laugh out of this. So my brother-in-law's a realtor, and of course I had the Zillow app on my phone, and I'm always looking for land.
Yeah.
And there was 20 acres near where I live with a house on it that's bigger than my current house for a pretty good price. It was a foreclosure, but I'm somewhat handy. Um, so we go out to look at it. Right as I'm pulling in the driveway, he texts me and says, "Casey, don't pull down the driveway." And so I stop at the top. I walk on down, and he has gotten himself stuck.
Oh no.
Oh, that's not it. So we call the tow truck and we're like, well, while we wait, let's go up and look at the house. So we walk up, and keep in mind, this driveway is about a half mile, is what it felt like. It's slippery as all get out. It's all dirt. It probably needed a good $50 to $100,000 worth of work. And so we look at the house. This foreclosure, and you've probably seen this before, they took everything. They took the doorknobs. They took every light fixture. We walked into the master bath, which actually looked pretty nice, and the toilet was missing. Everything was gone. If they thought they could sell it, they took it. And then we get back down there. The first tow truck driver gets there. He steps up. He goes, "Nah, I can't do it," and leaves.
Oh my gosh.
So we call, that was through his insurance. So we call our friend who runs a tow truck company. And he's like, "Yeah, I got the perfect thing to get you out, but we're working on it in the shop. I'll send a truck down. You'll probably be all right." We pull out the whole winch line. We hook up daisy chain, everything they've got, every chain they've got together. And it's still 140 yards short. So they call and have another truck come out with every chain they've got. And we finally get the truck hooked up. This is after about 4 hours. And we get it up to where the tow truck is. And the tow truck goes forward a little bit, and then it gets stuck. And so finally, about 8 hours later, and by the way, when the tow truck driver got stuck, I learned some new cuss words there. That was impressive. About 8 hours later, they finished working on the skid steer with the winch, so they were able to get that down there, pull their truck out, and pull Steven out. Once that guy got there, it was 20 minutes and they were done. But what should have been a 30-minute in and out ended up an 8-hour time at this property.
Oh my gosh. Well, and I'm sure
Great
there were,
property, awful house.
well, and it probably didn't have any of that in the description, right? Or-
No, and the thing that really gets me, and it really ticked my brother-in-law off, is the realtor's description. So you guys in your stuff get a separate set of notices than we get on like Zillow or something. It said, "Be careful during heavy rains. This may be impassable." It hadn't rained in days and days and days.
Oh wow. So just this is impassable. Don't
It's
attempt.
completely impassable at all times unless you're in a drought, I think.
Oh, well, we were looking, so Chris and I are looking at houses to flip. And so we have an auction on one right now that I say looks like something from The Shining. Like they have red paint everywhere, but it's not like a full coating of red paint. I mean, it honestly looks like someone's like run their hand down the door. It's so creepy, but I love it. I hope we get it. We'll see tomorrow. But so I'm on a very dilapidated properties drip. And my favorite came through yesterday. The house has been destroyed in a fire. I mean, you look at the pictures and the remarks that the agent has listed is calling all do-it-yourselfers. No, do not call do-it-yourselfers. You need some professionals in here. I mean, we're talking like structural issues. This is not throw some paint, update cabinets, update, handles. This is tear down or completely bring it back to the studs. So there are a few bad apples out there.
Yeah. Well, this guy in Spartanburg, he deals with like a lot of the foreclosures. So I think he sent a photographer out to the property and never even went himself. The photographer did an amazing job because the pictures made it look like a dream house.
Remember, we represent the seller when we list. and we'll talk about that.
Yeah. Just to answer one of my students, Rowan, I can't hear you at all. I think everyone's muted except me and Kelsey. So that's why y'all are having to listen to us talk. So, all right, it's 11. So I want to honor everyone's time. I'm gonna. Oh, I better get this presentation back to the beginning so that we can start at the right place. But we're gonna go ahead and get started. Before I share my screen and show you all the presentation, let me introduce Kelsey Bishop. She is our realtor extraordinaire, does an amazing job, and is in the Atlanta market right now, but used to be up here with us in Greenville, and she's been gracious enough to come back and help us out. And actually, like you said earlier, you're still doing some work here in Greenville, just not much.
I am. So,
So
hey
go right
guys,
ahead.
I'm happy to be here. Kelsey Bishop. I'm with Berkshire Hathaway. And long time ago, I thought I was going to be a doctor. So that's how Casey and I have that relationship. But I've been in real estate now for the last 4 years, and absolutely love what I do. This is why I'm here to help you guys because I know this is an exciting time. A lot of you have been thinking about buying a house now for the last couple of years. And, with residency in sight, you feel like you can actually put down roots. So I'm excited to be here with Casey, and please feel free to ask any questions. I'll put my contact information in the chat box too. So if you guys think of anything and we don't get to it, like I said, I'm always available. So looking forward to it.
Great. And just for everyone who's on, last year, I think this was the very last event that we did in financial aid before we went out on COVID for everything. So without further ado, let's get to it. And Kelsey, as always, interrupt me as much as possible because you have a lot more knowledge on some of this than I do. There we go. Can y'all see that? I guess it helps if I pull up the tool. There we go. All right, good. So let's jump to it. We're going to pretty much start out with the first question of should you buy, should you rent? Then we're going to jump into what mortgages look like and physician loan programs, and Kelsey's going to help me out with that a good bit. And then we're going to kind of move forward to, okay, if you've decided to buy, what does that look like? What are the things you need to look for? Like the story I was just telling Kelsey about my last time looking at a house, which by the way has cured me of looking at houses. Instead, I'm just refining and staying where I am. And then Kelsey, you're definitely going to help us with what does a realtor do for you. So jumping right in. So anyone want to give us an idea of what are your thoughts on whether or not, what are your considerations when you're talking about renting or buying? You can put it in the chat, or you can just unmute yourself and share it verbally.
I think if you're going to be there long enough to not lose money, it makes sense to buy because buying your mortgage monthly is way cheaper than rent monthly.
Yep, and in most places in the country, or at least a lot of places in the country, that's absolutely right. Anyone else?
Cost of maintenance and appreciation, or God forbid, depreciation.
Yep, I'll show you an example of that in a little bit, but good considerations there. Someone else jump in. A lot of times what we hear from folks is, I feel like it's just time for me to buy. I'm graduating med school. I'm possibly getting married. I'm, all of that. And that's a consideration. I would say of the ones listed, y'all listed the much better considerations. But stage of life is something that makes us at least start thinking about it. And then the likelihood of mortgage financing based off pre-existing loans. So we'll talk about that when we get to the mortgage section a little bit more. But as far as things go, the way I always look at mortgages, and I might say this again later, is there's kind of three tiers of mortgages that I like. There's VA loans are kind of the top tier, usually some of your best interest rates and easiest underwriting and no PMI. Then there's your physician loans are kind of the next easiest and best in most cases. And then after that, we start getting into the conventional loans. Kelsey, what are your thoughts on that?
Yeah, and like you said, we'll talk more about, the specifics of the different loan programs when we get to the mortgage part. Um, there are a lot of good incentives, and you guys have touched on a few things when considering renting versus buying. And like you said, one of the things that we will talk about is you want to make sure you're not going to lose money. Our market right now is unbelievably strong. Houses are being sold within a couple of hours of hitting the market. And I mean, for first-time home buyers, which I love working with first-time home buyers because there is so much more education that goes into it. It's been a lot harder for you guys because instead of being able to look at a house and going home to sleep on it, you look at a house and there's that competitiveness that you have to be able to put your offers in immediately. And so that's great right now for sellers, but also we want to be conscientious of buyers to make sure that you guys aren't overpaying. And with physician loans or the VA program where you end up putting 100% down, and again, like we'll talk more a little bit about this, but when you're doing 100% financing, we do want to make sure that you plan to be in the home for 2 years or more, just because of how long it takes you to pay down that principal. So when you go to sell, you're going to be able to recover the money that you owe. And like I said, we'll kind of talk more. But obviously, I'm a huge fan of buying. I have bought a couple of homes myself and love that you can personalize and just do more to it versus renting. But of course, you have that home maintenance that we talked about too. So,
Yep. All right. Thanks, Kelsey. So the general advice, so you just mentioned 2 years in terms of kind of recouping. If you look up nationally, most national things will tell you about 5 years is how long you need to be in the house. Now, granted, most of this was written before interest rates dropped to these really ridiculously low numbers. So it's a lot easier to build equity a lot faster now. And I'll show you that in just a second. But 2 years is kind of the bare minimum. I generally am going to go 4 or 5. If I'm going to be somewhere 4 or 5 years, that's when you're, well, not guaranteed, but almost guaranteed to have at least made some money on the house or be able to recoup what you put into it after you pay all of those fees. And a lot of people think, well, I'll buy it and then I'll sell it for what I bought it for, and I'll be okay. Which is not entirely true, because when you sell a home, anytime you sell a home, you've got about 8% that you are paying the realtor. So, folks like Kelsey need to get paid. And she doesn't get the full 8%. You get what, 3% as the selling agent, and of course part of that goes to your broker and everything like that.
yeah, typically we see the 6% in real estate commission fees. So that goes to the listing agent. And keep in mind all of the fees that they incur with the photography, staging of a house, marketing, and then they pay out the other to whoever brings the buyer. So all of you right now, in the position of a buyer's part, you have like the easy part because you guys don't pay to use a realtor. Everything does get taken out on the seller's end and the proceeds of the sale. But Casey is saying, I actually just had this happen with one of my good friends. We did 100% VA financing July of 2019, and they're expanding their family. And so this super cute starter house that we found for them would have been perfect if they were just adding a baby, but they added 2 dogs and a cat and their teachers. So now they're working from home virtually. So this perfect starter house now feels like they're so cramped. And, we were trying to figure out, okay, you guys did the 100%, you've been there less than 2 years. Right now, we have to play with numbers to make sure that you're not having to bring money to the closing table, because you also have, your taxes. For South Carolina, if you sell in July, you still owe taxes for January through July. We pay taxes in arrears. So there are other expenses. So like Casey said, if you think, well, I spent $300,000 when I bought the house, so I'm just going to list it for $300,000 and call it a day. No, you would actually end up having to list it for significantly more to make sure you cover that commission, taxes, and then the different title fees that the lawyer's office charges.
Yep, absolutely. So here's a couple of examples. I ran the numbers, and I used a $200,000 house on this because that used to be kind of a good starter home, and nowadays with the seller's market, it's gone up a little bit more. When I used to do this presentation in the past, we used 150, but those days are long gone for most markets. And so, if we look at this, and you've got a mortgage, you can rent for the same price that you can get your mortgage for, right at $1,000. This is $200,000 house, 100% financed. No HOAs, things like that. We didn't toss any of those extra costs and things in. At 5 years, if it goes up in value 2% every single year, at the end of the day, even with these lower interest rates, after you pay that 8% fee for selling your house, you actually end up with $832 less than what you paid for it. Now, you can see on there that you built about $27,000 in equity. That is honestly the amazing part of the interest rates now. So you're getting back some of what you paid. That's a really good thing. I will say, though, this also makes the assumption that absolutely nothing goes wrong. And every time I bought a house, something has gone wrong. We just put a new roof on our house. It just, things happen. And when you own the house, you're kind of responsible for it. Now, if we look at it a little bit different, we're renting. You find one of those markets where renting is a little bit cheaper. You save over those 5 years in terms of actual cash going out of your bank account. You save about $9,000. On the other hand, you do have to weigh that with the equity that you're losing. So you're losing about 17, almost 18 grand in equity that you could have been getting back. But if you make this decision, it could be a matter of just what can you actually afford based on the pay at residency, based on other obligations that you have. Things like car loans and that sort of thing are going to take away from you being able to maybe spend what you want on your housing each month. And then we flip it the other way, where renting is more expensive. At that point, you still have the same check at closing. That's that $27,000 in equity that you've built, of course, minus the $832 that you're kind of missing on the value of the house that you've lost. But you've also saved an extra $9,600 in this regards. So a lot of considerations there. It's in some ways it's going to really depend on where you go. And remember, these numbers are over 5 years. Mortgages are really heavily front-loaded with your interest. The banks want to get their money early on. And they know they can, because later when you tend to be making more, you might pay it off faster and they're not getting as much money. It's also just how simple interest works, in that you pay down a little bit of the principal each month, and the more you pay down, the less interest they can charge you. But ultimately, the bank's trying to get their money early on. And here's some examples. I've got to move some of my windows on the screen that y'all can't see so that I can see these. But I really like looking at long-term trends when it comes to housing markets and where I'm looking to buy, specifically by things like zip code or by neighborhood. And I lifted these straight from the app called Zillow. There's other ones out there. Zillow just happened to be who I used, and I like their app. But if you look at this, if I'm looking at a long-term trend, I really like this one out of Greenville, South Carolina. So right here in town, this shows dates that have gone through recession and everything. And by the way, we're going to ignore this dark blue line on this one because that's the particular house. Those vary a lot more than an area. But it's pretty much showing that this neighborhood, Pleasant Valley, is on a pretty steady uptick. So over the years, it's going to go up, 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 up. And maybe during a recession or something, it's going to level off. But it's not going to see major drops like we saw, say, in Florida or things like that. And then Greenville in general was even more protected from it because we're looking at more data. It kind of smooths out the lines a little bit. Um, that's probably the best you can look for is if you look at long term and you see a steady uptick, especially if you can look at it in time frames that included downturns, you're probably in a safe area that you can expect that your house will at the very least maintain its value, but likely will go up. On the other hand, you might end up in Nashville, which has seen some major changes over the last few years, and their economy tanked just a bit, so it went down a little bit, and then it started going back up. But the part where it went down was very minimal. We didn't see major changes, but we did see some, and then it went up and started kind of leveling off where we would expect it to be. Now, this area, if I pulled up even a newer map that didn't include the recession, or one of our last recessions, I should say, then it would show that the housing prices have even gone up more because Nashville's a pretty growing area. People are moving there. They're kind of flocking there. And then we get down here to the bottom. So I mentioned Florida. Florida's here on the right. This is actually Newport Richey, where some of my family lives. And for a while, I was watching home prices in their neighborhoods, just kind of keeping an eye for them. And what we saw is their economy tanked. Their housing bubble completely busted. It was just awful in Florida. Houses that people bought for $300,000 were going for $100,000 in my grandparents' neighborhood because they overbuilt, and then the economy tanked and no one could afford things like their second home and that sort of thing. It was a lot of second homes. So their graph here shows a huge drop and then showed them barely recovering when the economy was really pretty well recovered. So we don't want to see that. And then over here on the bottom left, we actually have my example of home buying. And you don't see on the left side of this graph because it doesn't go quite back far enough, but it has another area where it was dropping down further. And I will tell y'all, my wife and I thought we were buying at the bottom of a bubble, thought we were going to get a good deal. And then this little dollar sign right there is when we sold, and you can see what happened afterwards. That's when we moved up here to Greenville. And we had to bring money to the table. We bought the house for about 160 and sold it for 150. After having done a whole lot of work to the house to get it where we wanted it while we were living there. So things to be very cognizant of. I didn't know any of this back then. So we just said, hey, we want to live here because it's near where Stacy worked and closer to where I worked. And we said, well, we'll buy it. And we probably should have looked a little bit more. Natalie, let me look at your comment here. So Natalie says, given that the current seller's market, most people she knows are putting off buying the home. Do you think it's advisable? Yeah, you go right ahead, because the real question here is this sustainable? What do you think?
Yeah. So 2020, if we look at the graphs from 2020, they are pretty indicative to show us that we have continued, even throughout this pandemic, that we've continued to see growth. We have said, okay, are we growing at too great of a rate that we are going to see a recession? A recession always happens after periods of growth like this. The cool thing was that in March of April of 2020, we saw a slight dip, and then the numbers came back stronger. And so now what we're seeing, even as we're in 2021, is that the buyer need for homes is continuing to increase, and the inventory that we have continues to be lower than that. So do you put off waiting? No. I think the easy answer to that is to say, when you find something that you want and that fits what you guys are looking for, with interest rates as low as they are right now, it 100% makes sense to purchase. The anticipated growth that we're seeing for 2021 is a 5.9% increase in home sales and a 6% increase in home sale price. And that is, that's again, like exponential. But like I said, with interest rates as low as they are, it still makes sense for buyers to jump in. You just want to be strategic. And when we get to, why do you work with a realtor? What are you looking for in a realtor? That's where that plays such a huge part of this whole process so that you have an advocate who's going to make sure that you're not overpaying. You know, there are sellers out there who are trying to take advantage of such a strong market, and guess what? Their homes are sitting, or they're not appraising. Because even though we're seeing this increase, just remember when we had our big downfall in 2008, which was caused by us, that was a huge fail on the home buying sector. And what had happened was mortgage companies were giving mortgages out left and right. Do you have a pulse? Great. How much to hear you? We're going to approve you for a $500,000 house. No questions asked, no money down. And so what happened is that all of these people ended up getting approved for things, and they were buying houses that ultimately they couldn't afford. And so that was why we saw such a huge rise in foreclosures, and the market just completely collapsed because that was not sustainable. Now we're seeing inflation in prices, but our mortgage lenders have become much harsher, which we'll talk about, because I promise that process, you'll feel like they're going to be asking for a blood sample with sometimes how that underwriting process goes. But we're being so much more strategic, we're being so much more strategic that we are putting a little bit more protection. And I saw the question, so asking what types of interest rates are we expecting to see? Interest rates are dependent upon your credit score. So I am not a mortgage lender. We are seeing rates in the high twos, low threes, which, I mean, it was not many years ago, Casey, I'm sure you remember, we were seeing interest rates 10 to 15%. And people had said, oh, we'll never get interest rates below 10. And then we saw them go to the twos. And so with the pandemic, they hit a little bit higher when we weren't sure what was going to happen. They got up to 4%, but they've since come back down. Most of the buyers that I'm working with right now, like I said, are in those high twos, low threes, but it does depend on what your credit score is.
And Kelsey, are those 30-year mortgages?
Yes, 30-year fixed. Because we will talk about fixed versus ARM, but I'll say it now, with where we are with interest rates. If any lender tells you that an adjustable rate mortgage is the way to go, please question them every step of the way, because I don't know why you wouldn't lock in at 2.5%, 3.25%, when, like I said, we have seen rates go as high as 10. You wouldn't want to get hit if something did happen and we saw interest rates hike like that.
Yep. And I would also just add that, on the interest rate thing, if you are dual income, or if you are moving to an area where the housing is cheap enough, you might even consider a 15-year, because, my refi is going at 2.25%, and I've got friends that have gone even lower. But so, again, dependent on credit, dependent on your underwriting. But in y'all's case, they like you doctors. So you're a safe bet. Doctors on average default on their loans less than 1% of the time. So you're a pretty safe bet, and they're willing to take a risk on you because it's such a low risk, and they're willing to give you kind of some preferential treatment on that as well. So yeah, let's jump on a little further on this. So what else are you going to consider? Some of you mentioned the upkeep and the repairs. I mentioned we just put a roof on our house. Thankfully, we had a good hailstorm in April, and that paid for the roof on the house. But otherwise, that would have been almost $10,000 for our house. That's kind of high up there. If the roof is old, you need to keep that in mind and know that you're likely going to have to replace it if it's getting to 15, 20 years old, or pray for a hailstorm. We literally had some work done to our chimney, and the guy that went up there and looked at it, he said, y'all pray this year for a hailstorm, and if you get one, that's great. You can get a new roof that way. Otherwise, start saving for it, because you're going to need it very soon. And then, how old is the HVAC unit? I hate to say it, they don't make them like they used to. They're way more efficient these days and cheaper to run, but they're probably only good for 10, 15 years. It just depends. I've had to do some repairs on mine in the last couple of years because mine are 8, 9 years old. We've got 2 at the house. Are there other repairs that are going to need to be done? If you're looking at houses and there's things like water damage and that sort of thing, I'm going to tell you to run unless you're extremely handy or are practically stealing that house. What's upkeep like? Does it have a nice yard? Are there neighborhood standards? Are you where I want to live, which is hidden way back in the woods with no neighbors, and it doesn't matter what your yard looks like? Way less upkeep that way. What does your insurance cost? Every state's going to be a little different on this, and every insurance company is going to be a little different, but factor that in. And then taxes. So when you buy the house, you pay taxes. When you live in the house every year, you're going to pay taxes on it. So what do those look like? Now, we'll come back to this a little later, but a good mortgage lender is going to give you a good faith estimate that's going to show you about what that should cost and build it into your monthly escrow. But you need to know what that is. You also need to know that if you are thinking about keeping a house after you finish residency and move away and are going to rent it out, how do the taxes change? Because in South Carolina, the taxes pretty much triple if you're using a second house as a rental, or even if you just simply have a second house. If it's not owner occupied, taxes get expensive on that. So plan for that in advance. Also plan for how your insurance is going to change in advance if you're going to do that. And then start looking at how the house compares to others in the neighborhood. There's kind of an old adage that says you don't want to be the nicest house in a neighborhood. Someone's always going to be that house, but you don't want to be buying the nicest house in the neighborhood because it's more likely, not guaranteed, but more likely that other people may drag your house value down with how they upkeep their neighborhood, the yard in their neighborhood, and things like that. You also probably don't want to be the worst looking house in a neighborhood because then you don't make a good neighbor. But you want to be kind of average for that neighborhood, and that means when the neighborhood goes up, your house is going to go up. So how do you compare to the neighbors right beside you? If someone's coming to look at your house when you're selling it, and there is the most beautiful house that they've ever seen right next door, it might just make your house not look as good if it's not as upkept. Or if you look way better, we had trouble selling our house in Columbia in part, that money sign way down on the graph, because our neighbor's house was a dump. It had a big airplane hangar type place in the back of the yard, and we ended up having to put a few $100s into a privacy fence on that side so that people wouldn't see it. And after that, the house actually sold pretty quickly. So things to keep in mind. And how does it compare in terms of amenities? What does this house have compared to others in the neighborhood? Does it have granite countertops when everyone else has cheapo countertops? Does your house have cheapo countertops when everyone else has granite? That way a house in the neighborhood that has it is probably going to sell faster than your house. You might have a little trouble. Kelsey, what do you think on these? Anything else they should be watching for and how they compare?
Sure. So I think that you did a great job explaining. I can speak to Georgia and South Carolina real estate since I am licensed in both of those states. When it comes to knowing the full picture of the house, in both Georgia and South Carolina, and I believe a lot of the other 50 states, but like I said, I don't practice there regularly, so I don't know for sure. But we have something called a property disclosure. And in the past, I've brought them to these lunch and learns to be able to show you guys kind of how it lays out. But when a seller goes to list a property, unless it is a new construction home, because obviously you expect everything in the house to be new, you're going to get this report that the seller has filled out. Now, a human is filling it out, so they could absolutely be lying. But they're supposed to give you information to let you know how old the HVAC unit is, how old, when was the last time that they had to replace the roof. Have they ever filed an insurance claim on the property if their property is in a flood zone? If they have an easement on the property, if there's anything that was done to the home that was not permitted, just things of that nature to help give you guys the best picture and the best understanding of the home you're going to buy before you ever put an offer in. Now, once you put your offer in and you do, you negotiate the contract, which we'll speak about a little bit more in a bit. You'll go and you'll be able to either have like your due diligence period, which some states do. This is what Georgia does, where you basically have a certain number of days to do as many inspections as you want. Or you get a repair procedure, which is a little different than due diligence based on what you can ask for. That's the common practice in South Carolina. If something comes up during those 2 inspection periods in Georgia and other states, you can ask for whatever you want. If there's paint chips, you can ask them to repaint a wall. You can ask them to change an outlet cover. In South Carolina, the way we do it is if there are major problems, or I'm sorry, if there are problems with the main systems of the home, so that's including electrical, plumbing, HVAC, structural foundation, things to that nature, those are what you ask for. So you do get that window to say, okay, I would like the seller to repair these items, or I want money towards my closing costs, which we'll talk about too. So that I have a little cushion in case I do end up having to make these expenses, sooner than I thought. The other thing I like to advise first-time home buyers, which is applicable in any state that you're buying in, is to ask for a home warranty. A home warranty is not that expensive. Right now, I think the industry average is like $600, and it just adds a little bit more protection on you guys because you're going to be busy. I know some of you are more handy than others, but I mean, after you've been on call for, I have friends who are in their residency, and I mean, they're working ridiculous hours each week, 60-hour weeks. And I thought we said that this was not going to be a thing anymore. I thought residency was supposed to be back to 40 hours, but they don't cut you guys a break. So after having long weeks like that, do you really want to go home and have to figure out how to, add Freon to your HVAC? No. So with a home warranty, which we can get the seller to pay for, you guys are responsible for a service call. Now, with the home warranty, it does just cover the house. It doesn't cover, like I just had this happen too. So if it's not in your immediate house, but it's on your property and it's one of the plumbing lines, that's going to fall on you. But anything that happens inside the home would be covered under the home warranty. And like I said, you guys get a much more nominal fee than if you were to just take it, yourself. And then Casey, what you were talking about, how the house compares, absolutely. There's I think Joanna Gaines has said it on Fixer Upper, you want to find the worst house in the best neighborhood because that is where the maximum value is going to be. But there's a happy medium in with that too. And Andrew, I saw your comment about American Home Shield. Every insurance company or every warranty company definitely has their downfalls. And I think everyone will say, oh, this wasn't covered, but there are definitely some good ones out there, and really good reps too. If you build a relationship with a rep who's working, sometimes you can get a little bit of a better experience. But no HVAC people in Greenville. That's not good because Greenville needs HVAC, especially during the summer. Let's see. All right, William said, to the home warranty aspect, does that make a new build more appealing, or does the added cost of buying a new home outweigh the benefit? So, honestly, that's going to be personal preference. My husband would much rather buy a new home 10 times over than ever buying something that was older, even though we live in a home that was built in the 1970s. And the reason is because, when you buy new, you're the first one who's going to put anywhere on the home. When you buy a new home, the builder is typically going to put what's called a 210 warranty. And so 1 year of, you get, like, if they're nail pops, which is where they put the sheetrock over the studs, sometimes those pop through and you can kind of like see little bubbles in your sheetrock. So they come and fix those. If you have settling cracks, which are completely normal because you're building your house on the earth, and as all of you know, the earth rotates. So your house is also moving slightly each year. So for those things, the new build, you've got that. Then you typically have a 2-year on anything that goes wrong with like your HVAC system, plumbing. So things that are just covered under the manufacturer's warranty. And then they do a 10-year structural. So if there was something that happened with the home that was, monumental because they messed up, they're going to be able to cover that. So you get the warranty, you can get a warranty on either end, just in different ways. It really just depends on your personal preference. What you guys are more comfortable with. Like Casey said, a lot of the newer products that we're seeing, like some of these track home builders, hopefully they're not on this call, but they're building crap. they're building these houses in 4 months, and how do you build a quality home in such a short amount of time? So again, like, and we'll talk about this in the realtor section, I shoot it straight. Like I said, my husband, he's a residential builder, so I have a much more critical eye. And yeah, Margaret, I agree, builder grade, they're very poor quality, but sometimes they're nice. And if you get the custom home builder track home, there are definitely exceptions to every rule. But I have a much more critical eye when I'm house hunting with my buyers, and I will ask them up front, do you want me to be honest, or do you want me to just respond to questions that you ask? And 9 times out of 10, I'm told, no, we want you to tell us what you see, tell us what you think, because they want my opinion. But at the end of the day, your realtor will not be living with you. We are with you for probably like 45 to 90 days during this whole home buying process. And after that, you guys are the ones who are going to be calling this new house your home. So what I would say, like the blanket statement is, buy what you guys love. If it's new construction, great. If it's rehabbed or older property, great. And then we'll just do what we can to make sure you guys are as protected as possible.
Yep. And I would say even on new houses, because we bought a new house before and had to use that 210 warranty. The air conditioning went out after a year, and they came out and thankfully they just fixed it. And because it was in that first 2 years, they didn't even charge us the service call. They just fixed it. That saved us a good amount of money back when my wife and I were single income and, well, the first time, and not making too much. So that was a good thing. All right. So other considerations when you're buying. I promise some of the other parts will go a little faster. If it looks too good to be true, some of you who logged on early heard me talking about that 20 acres with the house on it that looked really good. There's a reason that they look too good to be true, and there's a reason why it was listed for what it was listed. On my way out the door to go look at that, my wife said, I really hope this is a great house and that we get it, or that it's such a bad experience that you are tired of looking at houses. And guess what? I got home and I deleted the Zillow app after this house. So, just it really, if it does look too good to be true, it probably is. If it is it a fixer upper? Are we talking some cosmetic things, or are we talking something structural? Because I've known quite a few medical students who have bought fixer uppers, and then they didn't have time to fix them up because they were an intern year, or throughout their whole residency, and things were just a lot more than it looked like. If we're talking fixing up in a matter of just, oh, it needs a new coat of paint, or oh, I'd really love some crown molding or something like that, that's completely different than fixer up, I need to gut the kitchen, or things like that. If you have the skills to do it, that's one thing. The second question then is, will you have the time? And the answer is probably not, but okay, maybe. But if it's something that's major and you're going to have to contract out for it, you're not going to have that good return on the investment, because you're having to pay someone else for their time and their expertise. You guys as doctors are going to get paid a lot. Okay, not as residents, I get that. But as doctors are going to get paid a lot because you've put the time into expertise. Well, guess what? Your cabinet maker is the same way. Different expertise, but a lot of time put into learning it. So you're going to have to pay for that time. And then think about improvements. We want to make improvements. We want to do this. You walk into a house and you start thinking about everything that you can change. So Kelsey flips houses a little bit. So, she walks in with that eye, but she also has a husband who is a residential builder. So major skills there. The rest of us walk into houses and we go, what can I change? And then we have to pay people to do it. I would say, what's that return on the investment going to be? And in my experience, this chart is a bit misleading, and it's a couple years old at this point. It makes it look like you're going to get back all of this money that you put in. That's probably not the case in most improvements that you do, unless you're actually adding square footage to the house. Instead, what you're going to be doing is helping that house sell a whole lot faster. Of course, right now, not as much of an issue, because houses are just selling really, really fast. I mean, we have some friends that their house was on the market less than a day. They got multiple offers and ended up taking $135,000 over asking price, and they didn't even want an inspection, which is,
No,
to me,
no,
that's a
no.
no-no. Always get an inspection, even on a new house. But any improvements you do typically are going to help it sell a whole lot faster, or at least on par with other houses in the neighborhood. If your improvements are bringing it up to scratch with those other houses, and never trust the salesman. Y'all, that house in Columbia that my wife and I lost 10 grand on, we also put about 10 grand worth of windows in. Great. We were thinking about it for the long term. I never thought I'd leave Columbia because when I left Spartanburg, I said I'd never go back. Well, you know, now I'm back and have been for, gosh, 9 years now. But in the long term, those windows might have been a good thing for the savings because it was a really old house with really bad windows and really drafty. But on the short term, when that salesman's telling you, look, you put these windows in the house, you'll be able to sell it for 10,000 more. No, that's a flat, bold-faced lie. It's not true. Never trust the salesman. Sorry if any of you are salespeople or married to salespeople. Never trust the salesman. Do your own research on this. And I was stupid and young and, shouldn't have spent the money I did. But, just keep that in mind. So, Kelsey, why don't you jump in on that?
Yeah, I'm going to jump in super fast. So what we said about home inspection, absolutely. Please, please, please get a home inspection, regardless of whether you buy a new construction or a resale home is what we call something that someone else has lived in before. It's going to come out of your pocket most of the time, which you would want it to come out of your pocket. You would never want the seller to pick their own home inspector because, I'm sure you guys can see where this is going. Wouldn't you pick someone who's going to say your house was perfect? Because then you wouldn't have to make any repairs to it. And the way sometimes the seller does end up paying for it would be through closing costs, which we'll talk about in just a few. But no, home inspection is a great thing to really give you a good picture. They're not going to catch everything. They're people, they're humans, they make mistakes. They can only see what they have access to. So if you have a seller whose garage is loaded with junk, they're not going to be able to move all that stuff to do a thorough inspection. But that can save you a lot of headache later. The fixer-upper, do you have the skills? Like Casey was saying, I love those. I absolutely love. I was telling him before before most of you got onto the call, if you were hearing some of our conversation, I was telling him about this house that we saw the other day. We have an offer in right now, and I'm calling it The Shining because it looks like someone just took blood and put it all over the walls, all over the doors. But I see the potential. It's the cutest little brick in downtown Atlanta. And so we're so excited about it. But, sometimes you read the seller's listing remarks, and I was telling him this too. There's a house that we came across had been in a fire, terrible, terrible condition. And the listing agent's remarks are calling all do-it-yourselfers. No, you're not calling all do-it-yourselfers. That is a house that's been in a fire. That is a huge concern. And that there's going to be a lot of levels to that renovation and repair that go far beyond any homeowner's expertise. I don't care how skilled you are, you're going to have to bring in professionals. And like Casey said, anytime you bring in professionals, you're paying them. They don't work for free, just like you guys don't work for free. So those are just things to keep in mind. And again, this all goes back to having an agent who's going to represent you, who's going to be honest with you, who's going to say, okay, let's not look at the fluff. Let's look at, the house. Because when you go in, and Casey talked about this too, when you guys go to sell in 3, 4, 5 years, whenever that time is, maybe some of you are planning to stay for longer than that. The goal is to get the home sold as quickly as possible for as most value, for as much money as possible. And the way we do that is we stage homes, and my kids will tell you that when our houses have gone on the market, they hate me because I'm like, no, 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 no. Like there are no toys allowed. Everything, like we ship everything out of this house. We normally get a storage unit to move stuff into because when someone walks in, I want them to be so blown away by how neat and pretty my house looks that they're not paying attention to maybe some things that I would go, oh gosh, okay, I hope they don't notice that that closet is so small because they're blown away by that emotion. And so as a buyer's agent, that's what I help my buyers look past. Okay, don't look at the decor because that stuff's all leaving. We want to look at the house itself. And, is this house going to work for what you need right now and what you're going to need, in the next 3 to 5 years? So I think that, I think you guys will be, honestly, I feel like all I'm saying is you want to make sure you're working with a good agent. Please, please, please do not contact listing agents who are representing the house that they're selling. Because all of these questions, is it too good to be true? Do you have the skills? What are the improvements? Don't trust the salesman. I, at the end of the day, am a salesperson. That is what my license says. I'm a real estate salesperson. And so you don't want someone to just swoop in and take advantage, because at the end of the day, their loyalty is to the seller and they're going to try to get the seller exactly what they can. So we want someone in your corner. And Addison just asked a question. She said, how do you recommend we find agents familiar with our financial and career specifics as residents in whatever area we end up matching? Great question. So I have contacts all across the country. I've helped a few of your previous classmates find people, but we do have agents who are specific, working with residents, working with physicians, working with physician products, because you really do want someone. The physician loans are a phenomenal product, and I think the next section, or we're close to talking about the mortgages, but it's a very unique loan product. I've closed, I don't know how many at this point. And I've had certainly a few hiccups with a few of them. So I have lenders that I've kind of like crossed off that I will not recommend. But yeah, if you guys, a lot of your residency programs will recommend an agent. But I'm also always available if you guys want to see if I have someone who I can recommend. Because at the end of the day, you want someone who's very familiar with y'all's situation, because it is just a little different than your typical buyer. And yeah, I have more to say on that, but I'll save it. Let's see. Jared said, as a first-time home buyer, what steps can I start taking match share even sooner to get ready to buy a home, like getting pre-approved? Yeah, so most of you won't find out until match day where you're going. There are a few good lenders for physician loans. Most of them, actually, I think all of them are banks. And I have a couple of contacts that I'm happy to share with you guys. Fifth Third is one of the ones that does a phenomenal job. Their interest rates have seemed to be the lowest, but really what you want to do is just, once you find out on match day, or if you already know where you're going, reach out to the residency program, reach out to me, and I can get you a couple of good people to reach out to. It's okay to run your credit multiple times when you're buying a home. People always worry about like hard inquiries, but it's okay to shop around. I can tell you quickly about, he's starting his fellowship. Yeah, he just moved to Greenville over the summer. Good friend of mine from college. Love him dearly, but he drove me crazy because every single time I got a text from him, he goes, well, I'm thinking about changing my lender. I was like, Alex, we are under contract. I'm all about you shopping for rates, but your time period to shop rates is like coming to a close. But no joke, I think we switched lenders 5 times and he ended up going back. He worked with Fifth Third. He went back to them because they had the best rate. So like I said, we'll touch on this a little bit more as we get to that section.
Yeah.
Everyone always wants to talk about money, Casey.
No kid. Well, I guess that is my job. The other thing I would add is that after match, you might be able to start the pre-approval process. This early, it's unlikely that you'll be able to unless you have a working spouse. Because what they're going to want as part of that pre-approval is a copy of your contract. And that's going to show what you're making and that you're guaranteed employment. Without that, they're going to be like, well, we don't know. So this will start after that, but you can start talking with them and find out what they'll need. I would also say, get your financial house in order. Make sure you know where tax returns are and all of that good stuff. Everything they're going to ask you about. And just quickly on the buyer's market versus the seller's market. Like Kelsey said, right now, it's a seller's market. Sellers are able to ask for and get not insane amounts, but pretty much what they want, as long as it's reasonable. and the houses aren't on there long enough to, unless there's an issue, they're not on the market long enough that people can negotiate with them too much. Most of the time when I'm talking with my brother-in-law and I'm talking with other realtors, he's saying, yeah, if I've got a house on the market more than 5 days, something's wrong with the house. And we're trying to work with that person to fix those things that are wrong. And that other houses that are just average are getting multiple offers above asking price with no closing costs. On the other hand, a buyer's market, which is unfortunately not what you guys are going into, for you, good for sellers, bad for you, or worse for you, not horrible. Buyer's market would mean there's so many houses on the market that people aren't getting a lot of offers, that there's not a lot of people buying, houses are sitting there, and it means you can get some better deals a lot of times, or get a better house for the same price as its neighbor. So that's just kind of how that works. Oh, trying to use the wrong keyboard. All right, now the money. So we're going to talk the terms, we're going to talk what paperwork looks like, and then we'll get into the physician loans. So we're starting with terms because you need to know what we're talking about. Most of these you should already know, or a lot of these you should already know from financial aid talks. But when we're talking about what a mortgage is, your mortgage is just simply your actual loan. When you sign it, you sign a mortgage note. And ARM, adjustable rate mortgage versus fixed, it is what it sounds like. An adjustable rate mortgage will change. Now, if interest rates are really, really high, an adjustable rate mortgage in some very specialized cases might be the way to go. But right now, interest rates are not high. Fixed mortgage is what you want. I would not let anyone talk me into an ARM loan at this point. Amortization, that's your total cost. A really good thing for you to do if you want to understand how mortgages work and how equity builds and things like that is to go and actually look at an amortization schedule. And you can look at this on bankrate.com. They have my favorite one, but there's a lot of other ones out there. You can just Google it. And it's basically your total cost. And an amortization schedule is going to break down every single one of your payments for those 30 years and say exactly how much goes to principal and how much goes to interest. What it will not show you, though, is the extra cost of things like your escrow, so your taxes and your insurance and things like that. And then there's closing costs. So we say, we ask the seller to pay closing costs, or this is the closing cost I'm going to have to pay, things like that. This is all of these things listed on there, and you prepay a lot of these. So you prepay some of your taxes in South Carolina. As a seller, you post-pay some of your taxes. You prepay part of your insurance because that's going to come due. You prepay a lot of these things. And then we get down to the good faith estimate, or GFE. This is really my favorite tool when looking at a house and if it's affordable to me or not. Because if you've got a good lender, they're going to give you a really accurate GFE. They're going to go do their homework. They're going to find the taxes on that house. They're going to find average insurance cost in the area. And they're going to be able to tell you you're going to need this much at closing, and this is how much your payment is going to be each month, including escrow. Those are my favorite. Don't bug your lenders too much. Wait till you're thinking about putting an offer on a house before you ask them for one. But they're the most helpful tool. And then there's something called PMI, which you guys don't have to deal with. But if you go with the conventional mortgage, primary mortgage insurance is what that is. And it's basically you have to pay for the insurance for the bank so that if you default on the loan, the bank still gets their money. That's what PMI is. And you pay that until you hit 20% value on the house. Then there's negative amortization. That's just a stupid idea. Don't do it. They sell this to elderly folks a lot, where a really low payment, but the house is actually depreciating. Your loan value is going up, and the banks hope they'll get that money out of the people's estate. Loan to value, get your appraisal. And your mortgage company is going to require an appraisal anyway, and they're not going to let you take out a loan for more than they appraise that house at. So things to think about. My friends that I mentioned that offer that was 35 grand more than their asking price, I have a feeling that their buyers are not going to be paying that because the appraisal is going to come back a little bit lower, and they're only going to be able to get what that house appraises for. But with all the other things they asked for, it's probably a good one. And then now just more. TILA is the Truth in Lending Act. That is kind of your protection, and it gives you a lot of information on your loans. It also means you sign a lot more paperwork, but this is important and good stuff. And then underwriting is the bane of your existence when you're buying a house, or I will even attest to refining a house. It's still the bane of your existence. So what's that paperwork? So the first major thing you want is a pre-approval. There's also what you would call a pre-qualification. This isn't near as strong as a pre-approval. Pre-approval letter is the bank saying, yes, we will give this person this amount of money. Pre-qual says, yeah, they're credit worthy and we like them. But I will tell you this up front: don't believe what they tell you in terms of what you can afford on a house. Most banks, even with all the new protections, are going to say that you can afford to spend 50% of your income on a house. In most cases, that's not a good idea. Like almost no cases is that a good idea. They're going to approve you as future doctors for $500,000 without batting an eye. But I can guarantee you can't afford a $500,000 house. Huh?
750.
Oh my gosh.
What
No.
we're seeing right now, majority of you will get approved for up to 750 with no down payment. And then if you wanted to go to $1 million, you just have to put 5% down. So that's, I mean, the physician loan plan, I mean, it's phenomenal to see you able to get access to that much house. You probably don't need that much house unless you have a ton of kids already, like I do. But
Okay,
yeah.
I've got 5 and I don't have near that much house.
I'm just saying. So yeah, 500,000. That may be where most people stay now. I had a few that went up to 500 last year. I know.
Oh gosh. And that's going to depend on market as well.
Yeah. Yes.
Right around here in Greenville, you can probably be all right at 300,000 for a starter home that will allow you to also grow your family if you are thinking about that. Then you get into the application process. That's where they're actually going to pull your credit if they didn't do it for the pre-approval. Honestly, if they're giving you a pre-approval, they've pulled your credit. And like Kelsey said, shop around on this. That's what I did recently, and I was able to pit my lenders that I was shopping around with against each other. And they were like, well, no, I'm going to beat that price. And then they came back and they did. I was able to get them down about a 0.25%. So do you get approved for mortgages after the match, after graduation, or after your first day on the work? Most people can do that after the match. Once you've got that contract, you're going to be pretty good to go. And that's the main thing in a physician loan that they're looking for is do you have a contract for a residency program? Because they know what your programs are like. They know it's guaranteed money. They know it's coming in with a raise every year. Again, they really like you, and your underwriting process is a little bit easier. Now, speaking of underwriting, it's a pain. Just go in knowing it's a pain. And even the day before closing, the underwriters are probably going to be asking you for another piece of paperwork that you probably thought you've provided them 5 times already. Right now, my refi is on hold because USC hasn't issued our W-2s for this year yet. So, guess what? I'm waiting on that process until I can get that, and USC is taking their sweet time. But they're going to want everything. Any assets that you have, or you hold money somewhere, proof that you've made payments on time. That if they ask for your bank stubs and it shows that deposit from a Grad Plus loan or something, they're going to want to know why you have that and where that's coming from, and make sure you're not borrowing to make the down payment and things like that. They have even asked for letters from me, and while they haven't asked for your firstborn child, it feels like it sometimes. Underwriting is just awful. Go ahead, Kelsey.
No, I mean, he's right. Underwriting is the worst part of this whole process. And I tell you that, so hopefully when you're going through underwriting, you'll go, oh, that really wasn't that bad, because I want to over talk it as much as possible. Jake, talking about your question, which I know Casey was talking about after match. So different physician loan programs offer different things. One of the reasons that I particularly like Fifth Third, the other one that First Citizens, I think, is the other one. They offer 90 days before you start your residency. They can close you up to 90 days. Some of the other ones only do 60 days, which is fine. That still gives you enough time to get into your house, to get situated, get unpacked. If there's any little stuff you want to do, paint, add a backsplash, that gives you that time. to be able to get everything done before your residency starts, because what you don't want is for residency to be starting like the Monday after you close on your house. That's probably cutting it a little too close. So that's one question to ask, because like he said, they're going to go off of your contract that you have from the hospital to know when your start date is. But 90 days that's a really nice cushion, as long as you have the money to make that first monthly payment before you're getting paid. Typically, unless you're doing a 15-year, with most 30-year mortgages where you're just paying once a month, what you'll see is when you close, you typically don't see your next mortgage payment for 60 days, sometimes 30. But so like, let's say we closed May 15th, most likely your next payment would not be due until July 1. So you would be given that, like you wouldn't have to pay June 1st, if that makes sense. The other thing that I wanted to touch on with those loan estimates, they're great tools and you can absolutely get people betting against each other. That guy that I was telling you about who we closed last year, who kept switching lenders, that was what he was doing. He was taking his loan estimate and going to the next lender and saying, beat this, like, what can you do for me? And on that note, if you guys or if any of you are looking to do new construction, sometimes new construction houses, their builder has a deal with a lender. And so they say, okay, if you use our lender, you're going to get all of these different incentives. Sometimes, it sounds too good to be true. And if you get that loan estimate, you'll see that even though they're telling you they're going to pay your closing costs, that money is being put somewhere else. So you're still paying for it. What I have found in my experience is up to right now, no builder lender has been able to beat the physician loan product that the private banks are offering. So that's just some food for thought. And like I said, a lot of this, as you guys start getting into the market, as you find out where you're matching, you're going to really need to be putting these questions like into action. So just don't ever hesitate to reach out to Casey or myself, as you guys are actually doing these things. Cause I know that I feel like we fire hose you guys with all of this information. Don't do this, don't do that. But those are just some little tidbits.
Yep. Sorry, my phone's going off here in the office. Just kind of moving on to what you'll even do at closing. So the paperwork's not done when you're done with the underwriters. When you get to closing, your arm is going to get tired because you're going to sign everything. Your mortgage note. It's literally the same thing as your master promissory note on your student loans, except it's for one loan as opposed to any loans you take out in the next 10 years. Any disclosures that you have. So I just signed one of my pre-closing disclosures. The mortgage, the deed of trust, that's where you sign your house over to the bank who actually owns it, even though you kind of own it. Certificate of occupancy, that's for new houses. They won't let you close without it because you can't move in until you have that. And then there's a lot of those other statements that Kelsey was talking about, the disclosures and things like that. An older house, that you're going to want a lead disclosure, especially if you're thinking of having kids and things like that. And even if not, you're going to want to know if the house has lead paint in it so that you can disclose it when you are selling the house. And then legal things, and you're going to have to sign everything like 3 times. At least that's what it always feels like. Word to the wise, for those of you who are married or buying a house with a partner or someone else, try and make sure they can be there, because if you have to sign as power of attorney, it's even more exhausting because you have to sign Casey Wiley signing as Stacy Wiley, and it takes forever. We've only done that once. We'll never do it again.
Well, and I'll jump in because you just brought up something that triggered another thought. So with some of you who are married and you're trying to decide, okay, are we going to do a joint? Like, are we both going to be on the mortgage? Or maybe your spouse isn't employed, or maybe you just don't need to show their income. Your lender is going to be they'll most likely run both of your stuff and they'll tell you what makes the most sense. Now, for those of you who are doing the physician loan, and so you're the only one who's going to be on the loan itself, you can still have your spouse on the title of the house. So even though they're not going through like the nitty gritty with the finances stuff, they can still have ownership over the home, which I know sometimes people are like, they really want to feel like they own the house too. So that's something that's very easy to be done. And then they'll still sign things at closing. They just won't sign nearly the amount of paperwork that you will sign.
Right. The main thing they're going to sign is that letter where you sign it over to the bank, and they sign away their rights on the house if you default on the loan, because that's what we're doing right now with us. All right. So what's special about physician loans? Now, I will say, go to the AAMC. They do a really good presentation on physician loans. A guy named Tal Frank does that. And their home buying workshop is all about the loan, not about whether or not you should buy a house. Because it's a lender doing it, so he's going to tell you should buy a house. But you can see right here, there's no PMI, which saves you, depending on where you are, that can be an expensive thing. Depending on how expensive the house is, it could also be expensive. Usually your contract is sufficient and it's easier underwriting. The bigger house, you don't get any interest bumps or anything like that. But again, you probably shouldn't be buying a bigger house anyway. And no to low down payment. Now, that said, there may be a couple of times where you'll consider another one, another type of mortgage. So maybe a first-time home buyers program will be a physician loan. It's unlikely, but it's possible. Quite frankly, the main one you'll see is if you have access to the VA mortgage. That is about the only one that is consistently better than anything else on the market. And even then, sometimes you'll find a physician loan that's going to be a little better, because the VA can occasionally be a little bit of a pain to deal with. But that said, their credit limits are easier. They don't require a down payment. And again, just a good loan all around.
Well, and Casey, Natalie asked, is the physician home loan good for life? Like if we decide we'd rather buy in a few years? Absolutely. As long as you're a physician, you can always take advantage of the physician loan. Something to note with the VA loan, you're welcome. As long as you're in the military or you've served in the military, you're always eligible for the VA loan. Something that's neat about the VA loan is that you can actually have two VA loans at the same time. They don't always tell you this, but it's if you're going to a different area or if the size of the home is changing. So if you're buying, which is just good, you may not ever need this, but I found this out probably a year ago. And now I feel like it's really good information to share because some lenders who don't do VA loans constantly or routinely, they don't even know that. But like Casey said, 9 times out of 10, the physician loan is going to be the best for you guys. And I mean, it's only available to physicians and dentists. Those are who this is tailored to. So it really puts you guys in a cool situation to be able to get, to be able to close on a house before you really have a job. I mean, like I said, some of you'll be able to close 90 days before you actually start. And that's just really cool because most of the time you can't start, or you can't buy a house until you can show that you have made income. So I think it's a great program to take advantage of.
Yep. And there might be a few occasions where you're going to look at a traditional mortgage. Even then, probably most of the time your physician loan is going to come out better, but it doesn't hurt to shop around. By the way, that hard hit on your credit, if you do multiple within a 30-day period, it only counts as one. So you might see a 1 to 2 point dip in your credit score, but not anymore because they expect you to shop around for these big purchases. But if you've got a sizable down payment, might want to look outside of a physician loan. Again, still look at a physician loan. You don't want to start out the 8% underwater by, if you sold it the next day, you'd have to pay 8%. That's again, you would have to have that down payment. Or you can make a down payment on a physician loan. So that's not an issue either. Maybe you have a working significant other who can get you a good rate, or maybe they have access to the VA. And occasionally, so this isn't the case lately, but historically, physician loans have had slightly higher interest rates because they're taking a little bit of a risk because you're taking that loan out before you do have income. And by making things easier on you, they're like, well, we're going to charge you for it in the interest rate. Lately, though, we haven't found this to be the case. Physician loans are coming out exactly the same in terms of interest rate on everything else.
I agree.
All right. So if you buy, what should you consider? All right. So you're buying. Don't buy more house than you need. Okay. Can you use a physician loan more than once? Absolutely. You just can't have multiple at the same time most of the time. So buy the house you need, but buy the house that you think you're going to need based on your plan for how long you're going to be living in it. Don't buy a one-bedroom house, which is unlikely anyway, but don't buy a really, really small house if you're planning on expanding your family. Now, I know you can't predict the next 5 years perfectly. What's the thing going around right now is no one at a job interview 5 years ago got that answer right when they were asked, what are you going to be doing in 5 years? No one did. But based on what you can plan, do plan for that house. My wife and I, we bought our first house and we planned for one kid. And by the time we were thinking about our second kid, he wouldn't have fit in the house. So we had to move sooner than we had originally planned. And then also, I hate to be the pessimist, but plan for the worst case scenario. Start thinking about, okay, based on the property disclosures and things like that, can I afford everything that could possibly go wrong that might not, but could? Can I afford to replace the HVAC? Can I afford to replace a roof and things like that? Can I afford if this issue that is very minor gets worse or something like that? Plan for that and just ask yourself that question and factor that into your savings because you're going to need to do that. Also check your reason for buying. Why am I buying? Am I buying because my family tells me it's time to buy a house? That's probably not a good idea. You need to buy if it's the right move for you. And to do that, you have to get the emotion out of the equation. It's almost impossible to do that completely. We all know that. Even the most logical people are not able to take emotion out of the equation completely. But do your best. As parent and homeowner, when making a future budget, keep in mind that daycare, whoo, ouch. Daycare's gotten expensive, y'all. So budget for that. Budget $800 a month per kid. Yeah, and I love the fact that you're all jumping in. Y'all, I'm going to also say this is highly. Oh, go ahead, Kelsey.
Ours jumped up with $2,000 to $2,400, which is why my mom is currently watching Charlie.
Oh my gosh.
$2,400. Like, well,
The bigger the city, the more expensive the daycare is, I've found.
that was in Greenfield too.
Well, that's true.
But we pick we have good taste too. Like they were teaching him Spanish, like they were teaching Liam Spanish, so you pay a little bit more, I guess, for that. But still, 24. I think Primrose is at $2,400 too, which is
Well, I've been out of the daycare game for a long time.
Congratulations.
2 kids in daycare, it was only $400 a month, but that was in Colombia. Yeah, nanny share with residents. There you go. Similar price, less kids, and there you go.
That is a good
That's fine, Margaret. That's good advice because a lot of you may be thinking of starting families going on. But kind of coming back to the getting rid of the emotion, make a pros and cons list. Make that worst case scenario list. And do your best to take how much you love how someone's decorated the house that you're looking at buying. Take that out of the equation and look at it realistically. Go into it looking at it like a pessimist. Anytime I walk into a house I'm going to buy, I'm looking for everything I can find wrong in that house. And then I'm going to ask myself, am I okay with these things? And then if I am with that, I'll have the home inspection help me to determine if I'm not okay with anything else that they find. A good realtor will point some things out to you as well. And they're not home inspectors, but they can give you a good idea. I walked up to a house one time, we looked and the window didn't even go in and the realtor said no, because we could see that there were issues with water in that house. That realtor saved us some trouble. All right, major red flags. Major red flags in a house. What are the biggest ones to you, Kelsey? Because to me, water damage is always going to be one of the biggest red flags.
Yeah, no, absolutely. Water damage, which sometimes you'll see like staining on the ceiling, is a good indicator of that. Settling cracks, like I talked about earlier, your house is always going to settle, but if you're seeing large cracks and you're seeing them at every door frame, that's pretty indicative of a foundation issue. Crawl space, if your house is on a crawl space, you want to make sure that the piers, which most of you aren't going to crawl in the crawl space of your home, especially if it's a true crawl. I don't crawl in the crawl spaces. My husband enjoys crawl spaces. It's just that manliness, I guess, that he has. So yeah, foundation issues are probably my biggest concern, and like you said, water damage.
Yep, and there could be some other red flags that you could find. Doors that stick. I mean, depending on how old the house is, that can be a sign of settling. It can also, just be a sign of poor construction every once in a while. But the water damage is going to be the main thing. Go ahead, Kelsey.
Yeah, no, and I'll say one more thing, and this is coming from a different perspective because of what my husband and I do, but one of the things that I look out for when I'm walking into houses with buyers, especially houses that claim to have been renovated or claim to have been flipped, remodeled. I'm telling you, listing agents, they are such good creative writers. They write the most beautiful remarks that you'll be able to fall in love with a home just by reading this description. But if you walk in and it feels cheap, like the floor is bouncing, right? Because they put the crappy LVL or LVT, depending on which terminology you want to use, and like it's the floating floor system, but they didn't do a good job supporting it from underneath. Or like you see things like, gosh, it kind of looks like they just painted over the plaster instead of taking it off and putting like new sheetrock on. Or wow, like those cabinets look like they were just painted over, but they weren't painted over well. If you see yourself questioning any quality of a flip, run. And the reason I say that is because if they're skimping on trying to make a quick return by painting that stuff, you have no idea what's hidden in that house that they decided not to address either. Because at the end of the day, most flippers are just trying to get maximum return. When Chris and I do houses, we completely gut to the studs and rebuild a brand new house, because that's just the quality that I expect as a realtor when I'm showing houses. So that's just, I mean, like I said, it could be structural, it could be water. You just don't know, because sometimes they've hidden it. But if they've hidden it, they've probably done a really crappy job. And so just pay attention. Also, if they've done a renovated kitchen and they've put laminate countertops in, no, they haven't renovated. That's no, move on.
Yep, there you go. And then there are red flags you might find in the neighborhood. This could be things like awful looking neighbors. This could be things like, to me, a major red flag in a neighborhood is, let me see y'all's neighborhood Facebook page and how are people in the HOA. I hate HOAs. I literally can't stand them. The one I'm in right now is awesome, but that's awesome for an HOA. It's like, oh, wow, I got in a car wreck, but at least this was a minor car wreck, sort of thing, to me. Other people love HOAs. Not many people, and they're all insane, but I just can't stand them. So to me, what's that neighborhood HOA look like? My neighborhood, like I said, it's a good HOA. The people are awesome. They're not petty. But I have some friends who live in a neighborhood in Spartanburg who the HOA is awful. And the neighbors complain about each other all the time. And it's just awful and really minor stuff. The friends that lived there had parked their car on the street to move cars around, and someone drove by in a golf cart, took a picture, and tried to find them for that. It was ridiculous. Some neighborhoods are like that, particularly if this is me being a little judgmental, particularly if you get a group of older retired folks in the neighborhood. They've got too much time on their hands. So what red flags have you found in neighborhoods?
No, I mean, I actually showed a house the other day, and as we pulled up, the house next door had a junkyard. That was not an HOA neighborhood. And so we didn't even go inside. It was, you don't want to wake up looking at that every day. I've had some where there are goats in the neighbor's yard across the street, and maybe you love farm life, maybe you don't like farm life. But I think, like he said, HOAs definitely get a bad rep because of the ones that are so controlling. There was a huge scandal in Greenville 2019 where the HOA board, the management company ended up taking hundreds of thousands of dollars and using it on something, which the money was gone even after he was arrested. And so now the HOA has had to like rebuild their rainy day fund. So unfortunately, stories like that give HOAs a bad rep. But then when I also show houses and I see yards that are unkept, or you see like, gosh, those people are going to really pull our property value down. That's where HOAs can come in handy, because they do require, a certain level of upkeep. You just don't want to find the ones that are so controlling. But like Casey said, the Facebook pages, next door, those are all good indicators. And also, like, I've done this when I'm out with buyers. We will finish touring a house and the neighbor happens to be outside taking out their trash, checking their mail, and I'll go, hi, I'll introduce myself, I'll introduce my buyers if it's something they've liked, and we'll actually talk to the neighbors to kind of get a feel for what they think of the neighborhood. Because a lot of times people will be really honest if you ask them those questions.
Yep. And this is the Casey Does Stupid Stuff file. You've already heard about the stupid windows. You heard about the stupid house we bought. And if you jumped on earlier, you heard about this story. And this is a good case of the neighbors being good resources, because after we'd been stuck for 6 hours, one of the neighbors comes up and he's talking to the tow driver. He goes, well, y'all ought to park a tow truck down here. 3 people a day at least get stuck looking at this house. I mean, real thick Packlet accent. But, just be careful. Know what you're getting into. Also, know that you can't necessarily trust what those seller's agents write, because the seller's agent had a warning about the driveway being impassable during heavy rains only. This was days after a rain and an 8-hour ordeal. That probably cost a few $100s for the tow. So yeah, don't do that. By the way, the tow truck even got stuck. Yeah. Now you can be done laughing at me. All right, timelines. Average time needed to shop. You guys will probably start looking in earnest after the match. Right now, you might be kind of perusing Zillow a little bit, and that's okay. But after the match is when you'll probably want to do that. And then your time from an offer to closing is what Kelsey was talking about earlier. You've got, can you close 90 days out? Can you do all of that? But a lot of our students seem to close if they don't put the offers in on that week of vacation that they get, that y'all get during intensification. Some of you'll even close there, or you'll close right after graduation, getting ready. Gives you time to get acclimated to that new city.
Well, and I'll jump on. So I think now is a great time for you guys to be looking at different apps. I am not a Zillow fan. Casey knows this.
It's okay.
There are better apps out there. If you are in which I think Berkshire Hathaway is in like every state, but we have great apps that give you real time. As soon as you guys get plugged in with a realtor, they will put you on what's called an MLS drip. MLS is our multiple listing service. Zillow and other Realtor.com, Redfin, Trulia. It typically takes between 15 and 30 minutes to get a listing to those sites once they've gone on MLS. If you're hooked up on an MLS search, you get that instantaneous. But I think Zillow, Realtor.com, Redfin, Trulia, those are great things for you guys to be paying attention to now, just because it helps you figure out like which areas or which houses you like. What you'll see is that those houses probably go under contract very, very fast. And so that's why I say it's okay to start looking now, because as you narrow in on different areas that you like or different neighborhoods, you go, wow, I keep liking these houses. And then I look on the map and they're all in the same area. Then when you find out where you match and you're working with a realtor, you'll be able to say, okay, I really like this area, which when you're working with a realtor, and the realtors that I work with, they know their stuff. They know their areas. So if you're matching in Greenville, most of you probably know Greenville pretty well at this point. But still, like, you want a realtor who's going to be able to say, Greenville's a great area. What is it that's important to you? And you may say, well, I want to be close to the hospital, but I don't want to be so close because I want to feel like I'm not at work when I'm not at work. And so they can help you figure out different areas as well. If you guys are moving to new areas, that's going to be where you really want to trust. You want to find someone that you can trust because you're going into this kind of blind. You visited, which I don't know how the interview process went this past year because of
All
COVID.
virtual.
Yeah. So you didn't really get to get like that full experience of being in the city, getting off the plane, seeing the airport, getting as much immersion. So relying on a realtor to say, what are the good areas? And we have to be careful because we are bound by fair housing laws and regulation. I'm also not allowed to steer you to say this is the neighborhood that you should be in because these are other doctors. But we can kind of give you a good idea of, if you want to be within a 10-15 minute drive to the hospital, some of you are going to want further than that. They are pretty good with giving you that. I've had a few friends who've moved to Jacksonville, and so I know their agent was very helpful with honing in on a particular area so that she felt comfortable. And I see how you switched the slide. Yes, what does a realtor do? We do a lot. I see, let's see who this was. Okay, so Brianna is asking, oh wait, I think there was another one. All right, so Abigail asked, at what point do we consider looking for a realtor after match, after pre-approval? For those of you who really don't know where you're going, wait until you match. Once you match, like I said, if you want to reach out to see if I know someone, I'll be happy to try to hook you guys up. Your residency may give you a realtor, but definitely once you guys know where you're headed, that's the best time to hook up with a realtor. They will also recommend a lender. And like I said, I have recommendations that I'm happy to give you guys. Like I said, Fifth Third, First Citizens, and I have people at those banks too who have done a good job in the past. I've used Regions in the past and they've burned me now on 2 deals, so I don't feel comfortable recommending them. Just because my buyers, my physicians that I was working with just didn't have as easy of an experience. And I hate that because they had done great stuff for me in the past, but the bad experiences unfortunately trumped the good ones. So I think after match, hook up with a realtor, pick their brain, see if they have any physician loan recommendations. You guys also have a lot of I'm losing like the forums, the med school forums where you'll see a lot of people get on those and they'll talk about who they've used, who they like. But once you do hook up with a realtor, once they give you that lending information, one of the things that I'll mention about your mortgage, like I said, most of you are probably going to get pre-approved for up to $750,000 with 0% down. And some of you may want to spend that. Most of you are not. And Casey's like, no, please don't spend that. And really, like he said, you make a list. What is it that you're looking for? And then talk with your realtor, find out about your demographics, about your area, because some areas you're going to, 300,000 is going to get you a shoebox. Some areas, 300,000 is going to get you a really nice 14 to 1600 square foot house that you could be really comfortable in for the next 5 or so years. And so what I like to tell my buyers is, instead of talking to the lender about your maximum pre-approval, go over what your income is going to be, whether it's yours and your spouse's, and come up with what you feel comfortable with for your monthly payment. And then when you speak with the lender, tell them we are comfortable keeping our monthly payment at $2,000 a month, $2,500 a month, $1,400 a month. And then let them run numbers and say, okay, if you want to keep your monthly payment at that, then you need to purchase at this price. And then of course, if you decide, you see the houses at that price point and they're not hitting what you're looking for, you can absolutely adjust. But I just think in my experience, that is the most helpful way to go about figuring out what you can afford. Because if you have your mind on that monthly payment, it just makes it a little bit easier. And then let's see. Brianna was saying, in some states where there is no income tax, is property tax usually too high to buy? I was told this by a resident. Um, different areas. So, like, I'm in Atlanta right now. We're in Cobb County. Our taxes are significantly less than Fulton County. Taxes are going to be different all across the United States. You've got your highest taxes in the Northeast. If any of you are planning on going north, and out west, the taxes can be pretty high too. Is it usually too high to buy? I guess that's probably a difficult question to answer. If it was too high to buy, then I think no one would be buying, and we still have people buying um, all across the board. So something to look into, but I think you guys will be fine. And your lender, like Casey was saying, with those loan estimates, they know these areas. They're gonna be able to appropriately put that stuff in. So at the end of the day, if you guys focus on what you want as your monthly payment, that'll help you really stay within a budget that you guys can afford, regardless of what property tax is on that subject property.
Right.
Do you
And,
jump in?
oh, go ahead.
Well, I was gonna talk about the other questions, like more about what we do, since I'm just
Okay. Then just real quick on those taxes is if they have no income tax, the property taxes may be higher because every state's going to get their money one way or the other. The kind of major exceptions to that are your big oil producing states, which tend to have low taxes, if no income tax, and sometimes lower taxes overall as well. But there's not a whole lot of those. I think Wyoming is the main one that comes to mind. But in most states, they're going to get their money one way or the other, and it's going to be pretty comparable from one place to the other. So if you're not paying income tax, you're paying property tax. If you're not paying property tax high, you're probably paying some income tax. Like I said, they're going to get their money, and it's going to pretty much even out. So I wouldn't say it's going to stop you from buying in those areas. By the way, that $750,000 house you're talking about, that is a mortgage of more than your take-home pay as a resident making an average salary. So that's a solid no from me. Go right ahead with what realtors do.
Hey, okay. So what does a realtor do in this process? I've kind of told you guys a few things, but really we're here to be your advocate. So a realtor designation is someone who belongs to the National Association of Realtors, which not every real estate agent is. Those of us who have the designation of realtor hold ourselves to higher ethical standards, which I think is important. And I think you guys, most of the time, if they are, it'll say it on their business card. Everyone who I work with is a realtor because I think it's important. But so we're here to be your advocate. We're here to be, someone that you can trust and confide in during this process, because for most of you, if not all of you, this is going to be the most expensive purchase you've ever made, with the exception of your medical school loans, which I'm very aware of myself. So you want someone who you can trust. You want someone who you feel comfortable, being in a group message with. I think, all of you, I would hope, are going to make fantastic doctors, right? And if someone had a medical problem, you would want them coming to you because of your medical expertise. You wouldn't want them going, to someone down the street. And so the same is true with real estate. If you have questions about housing, if you have questions about the home buying process, you want someone that you trust. And what we do is we are going to help you get set up with a lender if you don't already have one. We're going to help you get set up with a home drip campaign so you guys are getting access, because in the seller's market that we're in, those 15 minutes that it takes to get from MLS to Zillow, the house may already be gone. And that sounds crazy, exaggerated, and I wish I were exaggerating, but like that 15 minutes can make all the difference. So you want someone who is going to be able to set you up, to answer questions that you have about a specific area. But do keep in mind, like, the fair housing laws that we're bound by. You can't ask us a question like, okay, well, where do the doctors live? But we should be able to give you general ideas. If school zones are important to you, they can direct you to how to get the best information on the different schools for that area. Because I know a couple of you said you had kids. One of the things that I do when I'm working with buyers, it's not just the people, it's not just the person buying the house. They also have a family. They have kids who are about to be uprooted. And so trying to learn what are things that are important. I've helped people find gymnastics or cheer centers for their kids to make the transition a little bit easier. And, obviously they're going to get you into houses. You're not looking at houses by yourself. They're getting you into houses, they're pointing things out to you, and then they're working you through the offer. So most everyone knows that you have the first negotiation period of, your offer price, but then you also have a second negotiation, which is after you have your home inspections. And just to touch on like the overall offer. So right now in the South Carolina and Georgia markets, we're seeing homes sell for about 98.5 to 99% list price. Some of that is even higher. The homes that have been sitting on the market a little bit longer skew that number down, because what I'm seeing is most houses that hit go off the market fairly quickly. And when I say fairly quickly, I mean within 24 to 48 hours. And so your realtor is going to coach you on what a good offer is, because at the end of the day, we want you guys to be making a good investment. We want you guys to be doing something that you feel comfortable in. And we want to also help you win the house. And so there are strategies. Like right now, we're not seeing sellers pay as much in closing costs because multiple offer situations, but how do we position you to get you, to get you up? And sometimes it's giving them the story. This is a brand new resident. They're moving to the area. They're so excited. They love your home. They can see themselves settling down after years of studying. It's painting this picture, and that's what your realtor does when presenting this offer, to hopefully set you apart from the other buyers who might be looking at it. The second negotiation period is after you have your home inspection, right? So like I said, a lot of you aren't going to get closing costs right up front because you may find yourself in a multiple offer situation, but we can definitely get closing costs after the repair procedure, because sometimes instead of having the sellers repair items, we'd rather put that money in your pocket so you can take care of it yourself. And so closing costs typically run between 2 and 3% of your purchase price. So just be prepared for that. You should have that money on hand, even if you're doing the 100% financing. You will most likely come out of pocket between 2 and 3% of the purchase price. And those just cover all of your expenses with your lender fees, title, the deeds, this deed stamp. I can't think right now.
All of those huge number of things we put on that list.
Correct. That's 2 to 3%. So you may still be able to get that back. Again, like your realtor is going to be negotiating that for you. And then of course, getting you to the closing, because there's still like things that can happen. Most of the time, once you go through underwriting, you're in the lender's hand. The realtor doesn't do as much. We do a lot more like of the upfront. And then of course, we're there with you for closing. And even after closing, I have clients who still reach out to me if they have something that happens with their house and they're looking for a recommendation. When they go to sell, when they have friends who are looking to purchase or sell. So it's someone who you really are going to have for life. Is our goal is, we want to, like I said, I think at the end of the day, you're picking someone who you can trust, who's going to be your advocate. And so how do you pick a good one? I think it kind of goes back to when you guys were interviewing for medical school, right? You got to meet with a lot of different people and you kind of felt which one fit with your needs. Right now, I know some stuff is still virtual. I am meeting with clients in person. It's hard to see houses virtually, although we were doing that in March and April of 2020. So you just want to find someone who you mesh with. Who is it that you really feel like gets what you're saying, gets what you're looking for. And like I said, your residency program may have realtors that they recommend. And I'm also happy. If I recommend someone, it means that I'm putting my neck on the line for them. So I really take that seriously, because at the end of the day, I want you guys to make the most informed and the best decision as you go through this new chapter of your life.
And I would say it also comes down to a bit of a gut feeling. Talk with them, and if you like them, if they're talking away and work with you in a way that you like, that's a good start to that. Ask for recommendations from other residents, people who've used them before. is another good way of doing it. By the way, I got a question about the mortgages. What are the pros and cons of putting down payments, whether small or large? The main pro that I see in this is having some instant equity in the house. Knowing that if something happens and I've got to move immediately, which isn't the case for you guys really so much, that I've got some equity in the house. It also means that I own a little bit more of it, which is nice. I don't know. To me, it feels better, but I also don't have access to physician loans because, hey, I'm not a physician. It could also mean that you're building equity faster than you would otherwise, because if you are owing more when you could have put down a down payment, well, more of those early payments is going to be interest. If you put down some of that down payment, a little bit more of those early payments, while they're still going to be heavily weighted towards interest, a little bit more of them than they would have been are going to be principal payments and building more equity a little bit faster. Sometimes you can do it as a way of bringing down the monthly cost on a house to where it's more affordable to you. So say you're looking at a $300,000 house, but you can only afford the monthly payment on a $250,000 house. Well, you put down 50 grand if you've got it. That, I know that's a huge stretch for medical students, but if you happen to have it, or someone really likes you and gives you an awesome graduation present, also unlikely, but possible, then that could bring it down to where it's monthly affordable, but you also have that house that you wanted. A couple of just those random things to think about. All right. So other questions. I'm going to actually shut down the sharing of my screen right now, and I'm going to let y'all ask questions. So y'all jump in. What questions do you have for me, for Kelsey, for each other? If any. Well, I am not hearing any come in, and I'm not seeing any typing. I'll give them another couple of seconds. But
can you hear me, Casey?
I can. I don't know who I'm hearing. Oh, there you are, Andrew.
I just have a question since no one else is asking questions. Would you suggest like paying more on your mortgage than what it is? Like I know some people say invest it because of the opportunity cost, or like I know I got some loans, so I could put like an extra like $30 to loan repayments.
Gotcha. So if I'm looking at it during residency and I have some extra money, any extra money I have in residency, I'm probably throwing into my retirement instead of extra on my house. That said, if you've got a whole second income in the family and you've got a whole bunch of extra money, more than you would think, then maybe you can put some down as well as put some down on your retirement. The benefit of the retirement over putting it down on a house this early on is that retirement account's going to grow. And while your house value will grow, it's going to grow regardless of how much extra you're putting down on that. Now, putting down extra on a house is a good way to pay it off faster and to be done faster. But I think I'd still skew towards retirement this early in y'all's career. All right. Let's see. Go ahead.
I would say investments too. Like some of these, completely blanking, is it EFT? I think of EFT as electronic funds transfer, but there's some really good like investments that I think build faster than your retirement portfolio sometimes too.
Some of the shorter term ones. Although if you had bought GameStop stock last year, you'd be golden right now, but none of us saw that. Unless we were on that Reddit thread. So let's see. Someone's asking about budgeting and what you can afford. The average cost of health insurance monthly for residents. That is honestly a tough one because it's all over the place. I would say you need to come to my benefits session that we're doing, but you do find a range from this place will cover all of the health costs for you and your whole family. Some places will cover for only you. Some places will say we'll subsidize you, but not your family, and it's going to vary a lot. So really a whole lot there. The benefits session, I have to actually look that up. It was in the newsletter this week, but my brain was so focused on this, I don't remember. Um, sorry, I will have to get that to you. Oh, no, wait, here it is. February 12th. So it's a Friday. Keep in mind, I'm sorry, I'm trying to read that, and y'all are commenting. When renting a property from an owner, not an apartment complex, they can, within lease terms, determine year by year whether they still want to lease that property. That is absolutely true. So if you start a lease, the owner could determine to stop leasing it the next year and sell it instead, or things like that. So you may end up having to move. Multi-year leases really going to vary state by state, as well as landlord by landlord. So yeah, good advice there. Thanks. All right. By the way, one thing I didn't mention is that when buying a house, you probably want to be about a quarter to a third of your take-home income going to that mortgage payment. Is where you want to fall on that while you're in residency. Now, other times you might have to adjust that a little bit, or you may even need to do that in residency based on the market that you're in. If it's just a really expensive market, no matter what, you might have to go a little bit higher, which means you're going to have to sacrifice on how often you eat out and things like that. No matter what, I'll tell you that your financial situation in residency is going to be way better than it is in med school, because you're actually making money and you're getting a lot more money to live off of and make your decisions on. Usually about 2.5 times the amount of money that you have in medical school. So you're already going to feel like you're living like kings and queens. All right. Kelsey, any closing thoughts with us?
I think that's it. I really appreciate you letting me join this call today, and congratulations to all of you. I know you haven't matched yet, but you will soon. So like I said, if I can be of any help, or if you guys have any other questions, please don't hesitate to reach out. I'm always on my phone.
Yep, absolutely. And thank you, Kelsey, for coming in and helping us with this again. You know, I'm going to keep calling you every year until you tell me no. And thanks everyone for attending. All right, I'm going to shut it down now. Thanks, everybody.
Bye.
Bye, Kelsey. Well.